Billions wiped out as stock safety trade on Wall Street misfires. Reeling from a bear market last year, bidding up investors decided to send more than $60 billion to exchange traded fund focused on dividends. 11 months later, the trade is misfiring. Now, rather than give shelter in the stormy season, the largest dividend ETFs have been left behind the tech-obsessed market, whose biggest proxies have surged 15% or more. At the bottom of the leaderboard is the $18 billion iShares Select Dividend ETF, ticker DVY, down 5.4% on a total return basis after all-in bets on utilities and financial stocks fizzled. It's the latest lesson on the dangers of market timing. Investors wanted exposure to companies with a history of paying out profit as a precaution amid the Federal Reserve's most aggressive tightening cycle in 40 years. Instead, they were saddled with underperforming companies that proved especially vulnerable when yields shoot higher. The casualty list includes the $20 billion SPDR S&P dividend ETFs, down 3% SDY. On the total return basis, the Schwab US dividend ETF, SCHD, of 2.4%, and Vanguard's high dividend yield ETF, VYM, which is mostly flat for the year. Funds that have eked out gains have mostly posted small ones, like the Invesco Dividend Achievers ETF, PFM, which is up 6.6%. The ProShares S&P 500 Dividend Aristocrats ETF, Noble, which is up 2.3%, and the Vanguard Dividend Appreciation ETF, VIG for short, which is up 9.6% and focuses on mid and large cap stocks. Invesco's Nick Calibas said that PFM's lagging performance is linked to its underweight to the so-called Magnificent Seven and overweight to less growthy technology names like Oracle Corp, Cisco System Incorporated, and IBM Corp. ProShares said that the companies in Noble delivered fundamental performances, delivering earnings growth on average, even as overall earnings for the S&P 500 shrunk this year. State Street's Matt Bartolini noted that dividend strategies have a value bias and 2023 was a growth market. Vanguard and BlackRock declined to comment. Now, with a small handful of largely growth-oriented stocks dominating the market's performance, 2023 was a challenging environment for dividend-paying value securities, especially with the compelling case for fixed income in a higher rate environment, said DJ Tierney, senior investment portfolio strategist at Schwab Asset Management, which houses SCHD. For the most part, the flood of cash to dividend strategies meant investors got pushed into the likes of value stocks and out of big tech mega caps, which have driven the market gains. In the case of SDY, half of the fund is concentrated in three sectors that have declined this year: consumer staples, utilities, and healthcare. Its top holding manufacturer, 3M Co., has plunged 15%. Compare that to VIG, which holds nearly 1/4 of the fund in information tech, a rare feature for dividend funds. Now, the idea dividends enhance stock return is a selling point of brokers that is itself subject to dissent. Any payout that provides shareholders is effectively offset by mechanical declines in the price of the stock, the so-called dividend effect, leaving returns mostly a functional of stock picking. This year has been a particularly rough one for stocks valued for their cash flows because of increase in bonds yields, which represent competition for investors' dollars. Adam Phillips, a portfolio manager at Torrance, California-based RIA EP Wealth Advisor, says he's gotten numerous emails and calls over the past year from fund issuers pitching dividend-paying strategies. "We have not taken the bait," he said, who know that growth stocks aren't going anywhere, particularly if interest rates have peaked. He's not the only one actually avoiding the sector. Just $786 million has flowed into dividend ETFs so far this year, the smallest haul since 2006, according to Bloomberg Intelligence. Now, to be sure, the ability to consistently pay a dividend over a long time span is often a hallmark of a company's stability. Take the S&P 500 Dividend Aristocrats Index, which comprises S&P 500 members that have raised dividend for at least 25 consecutive years. While trailing its namesake benchmark, it's beaten nearly every U.S. active manager over the past decade. Raising your dividend for 25 plus years is no easy feat, said Rupert Watt, head of factors and dividend indices at S&P Dow Jones Indices. This high-quality companies. Versus the S&P 500's total return, however, that index has underperformed on a 6-month, 1-year, 5-year, and a 10-year interval. Sam Huzo, founder of RIA SGH Wealth Management, is constantly pushing back against his clients' requests for dividend strategies. His average client is 65 years old and finds comfort in cash flow dividend strategies offer. It's the perception that, well, at least if I get 3% in a dividend every year, I'm getting something out of this thing, said Huzo. But that's too short-sighted of a perspective, because if the price appreciation is worse because you're getting something that has no ability to grow, you're not getting the full value of those stocks compared to other places in the market. Meanwhile, bonds are offering some of the highest interest rate in decades, presenting investors with a more reliable stream of income than dividend funds. Ultra-short bond ETFs have pulled in $30 billion this year after holding a record $42 billion in 2022.